Hello learners, welcome to NIOS Studios. Today we are going to learn about financial statement analysis. And today, before we start with financial statement analysis, we will have a quick recap of what we have been doing in our accountancy sessions with you. You all have learned that we have identified transactions, recorded them in our books of original entry like the cash book, the subsidiary books such as the purchase book, the sales return book, the purchase return book and the journal proper. And thereafter, after journalizing, we went to posting these into our ledgers. Various accounts you build up and thereafter you also made the trial balance and thereafter you checked whether your debit entries and the credit entries posted in your journals and entered in your ledger were right or wrong. Thereafter, you went on to make your financial statements. The financial statements were namely trading account, profit and loss and your balance sheet. You also made a manufacturing account if you had a manufacturing unit. Now, we are at the end of the accounting cycle. We need to analyze and interpret what? The results of a firm, the results of a business unit. Why? You want to know what are profits, what are losses, if any, which your business unit has incurred. So, we will take a quick look at how do we do analysis. Now, if we look at the tools, there are many: comparative financial statements, common size statements, trend analysis, ratio analysis, fund flow analysis and cash flow analysis. But we will study today the ratio analysis. But before we go to ratio analysis, let us see who are the users of financial statements for whom we are going to do the ratio analysis. We have internal users and external users. Again, a quick recap of the external and the internal users. The internal users are all those who are working with you inside the firm, right from the top level management, the board of directors, the partners, the promoters, the managers at various levels, the auditors who are internal to your organizations and the employees of your organization. They are all keen to know the results, but some of them may not be able to interpret them as they would like it to be interpreted for them. They want these financial statements to become meaningful for them, and you as an accountant have to do the task of doing the ratio analysis and making it more meaningful for them. Now, we look at the external users. External users are those who are in the macro environment, those who are outside the business unit, but they still need the important information from you as to what those results, what does the income statement, what does the balance sheet show about your business unit. These are all your financiers and your investors who have lended you the credit, who have supplied you raw materials, inputs, intermediate goods on credit basis. Along with them are the public. Public comprises of all those who are exterior yet very interested in your financial results. These are the government bodies, the competitors who are always looking at chances to capture your markets, your customers who are ready to switch to other competitors who have similar products, who are selling similar services in the market like you, and of course, the researchers, the data analysis and the external auditors. So, now we will begin our session of today, the ratio analysis. Now, before we start ratio, we need to define what is a ratio. A ratio is a percentage or it expresses a proportion between two identified or two related financial data. Now, today we will first define the objective of ratio analysis. We were on the objectives of ratio analysis. I was telling you that we would like to do ratio analysis for the following reasons. First is we would like to know those areas of business which need our immediate attention as policy makers, as board of directors, as the internal component of the management of a firm. Second, we want to know those areas which can be improved to cater to the customers with quality products and services in the future. There where we can correct our variances, our differences, our shortcomings so that we do not go out of business very soon. Third, we want to analyze what has been our profit compared to other years, compared to our competitors, and also we would like to know the liquidity position, the solvency position and the efficiency of our operations. We would like to know that whether we are able to meet our short term and long term debt obligations to our creditors, to our suppliers of funds, etc. Third, we want to do a cross sectional study of our performance with benchmarking our performance with the industry standards. Third, we would like to provide this information derived from the financial statements useful for making future predictions and estimates for our policy makers in our management. So, we come to the first kind of R ratio, that is liquidity ratio. In this we will study today the current ratio and the quick ratio. Now, liquidity ratios are those that help us to identify what is the solvency position of the firm in the short run, which means we are talking of current assets and current liabilities. A quick recap at what are current assets and what are current liabilities. If you remember, students and learners, we have current assets, cash in hand, cash at bank. These are the most significant current assets. There can be more. There are bill receivables, trade receivables, sundry debtors, short-term investments, stock or inventory as you may call it, prepaid expenses, advance tax and so on. Current liabilities are your bills payables or trade payables, sundry creditors, your bank overdraft, provision for tax, outstanding expenses. So, we come back and if I define for you working capital, what is working capital? Current assets minus current liabilities. So, what we are talking about is in liquidity ratio is the proportion of current assets in proportion to our current liabilities. So, we will now calculate the current assets divided by current liabilities and get the current ratio. It will indicate the amount of current assets which are available for the repayment of short term obligations, which are also better known to you as current liabilities. 2:1 is the ideal ratio, but we would always like to benchmark it with the industry or with our competitors, so that we are always better than them. Now, we come to the quick ratio. Before we go to quick ratio, quickly we will also try to calculate current ratio. Here is an example, an illustration for you. We have inventories 50,000, trade receivables 50,000, prepaid expenses 4,000, cash and cash in hand and cash at bank 30,000 and trade payables at 1 lakh. Now, if we look at these, some are current assets. So, we add up inventories, trade receivables, current assets which come to 1,34,000, and then we add up the current liabilities given to us in this illustrations, which is trade payables plus short term borrowings, which come to rupees 1,04,000. Now, if we go back to our current ratio formula, it says current assets upon current liabilities. So, now we divide 1,34,000 by 1,04,000 and it gives a ratio of 1:1.29:1, which is not very close to ideal ratio, but nonetheless it is moderately inclined towards the ideal ratio. So, current ratio is the ability of the business to pay the amount due to stakeholders in the short run, which are short run or short term obligations as and when it is due to, and that is known as liquidity for the firm. It is an excess of current assets over current liabilities. So, we would always want our current assets to be higher and more than the current liabilities, but we must always remember there are exceptions. Exceptions are when there are slow moving stocks or pile up, and then it is not desired to have a high current ratios because your inventories are lying and it is not convertible into your cash or sales very fast. So, it is a matter of concern, and then a high current ratio is not desirable. Second exception is when there is slow collection of trade debts or your trade receivables. The trade receivables are high, but the collection is slow, which means cash and near cash or liquid cash is slow to come into the firm for its use in business or its operation, then also it is a matter of concern, and then a current high ratio which is high is not desirable. Third, when cash and bank balance may be a large portion of your current assets and may remain idle, which means you have investable funds, yet you are unable to find sources where to invest and earn money, which again means your current ratio is high, but it is not desirable. Now, looking at the other side, if the current ratio is low, then also it is risky and undesirable, because it means there are lack of sufficient funds or current assets to meet your current obligations or your current liabilities. So, learners, we have learned about current ratio. Now, let us talk about the second liquidity ratio, which is the quick ratio, also called by a better name, the liquid ratio. Now, liquid ratio will have the numerator changed. It will not be current assets, it will be current assets minus your inventories minus your prepaid expenses upon current liabilities. Now, this defines your liquidity to a more directly than compared to your current ratio, and therefore, after calculation of current ratio, most of the firms go in for the calculation of quick ratio, because it gives a better picture of the liquidity of a firm compared to current ratio, because we have deducted all the inventories and minus prepaid expenses, which are the slow moving current assets compared to other current assets. Now, we will have a quick look at the calculation of the quick ratio. Here we are given inventories 50,000, trade receivables 50,000, prepaid expenses 4,000, cash and cash at bank 30,000, trade payables 1 lakh. Now, if you remember, just now only I have said that we will remove from current assets the inventories and the prepaid expenses. So, here we go about it and we remove them, and therefore, we get 80,000 as a result, and then we have the denominator which is already calculated in the previous illustration as 1,04,000, and therefore, the ratio comes out to be 0.77:1. Now, the rule of thumb is 1:1. It is always better to have 100% quick assets compared to our current liabilities. If our quick assets are 100% of what we have as current liabilities, it is a very good situation for a firm. But nonetheless, in this illustration, we have 0.77:1, which means the firm is steadily walking and working towards a ideal quick ratio. Therefore, we have clearly defined that 100% of quick assets compared to our current liabilities is the rule of thumb, which is an ideal position for a firm. Now, we move on to the second part of today's session, which is talking about and learning about solvency ratios. When we talk of solvency ratios, we are talking of long-term obligations or long-term payments which the firm or the business unit is desired to meet for the various purposes for which it has obtained loans. It means we have to pay the firm's commitment, firm's obligation to pay timely debt, and that means the interest and the principal on the on the debt taken by it. Therefore, it indicates a firm's ability to meet the fixed interest and its cost and repayment schedules associated with its long-term borrowings. Now, we will be studying in today's session 3 solvency ratios: the debt equity ratio, the propriety ratio, and interest coverage ratios. Now, if we talk of the debt equity ratio, it is equal to long-term debt divided by shareholders' funds. When I am talking of long-term debt, I am talking of a period beyond 1 year, which means long-term borrowings plus other long-term liabilities plus long-term provisions. Remember, learners, never to forget to add long-term provisions. It is very important to add in provisions long-term in our long-term debt. Equity will comprise of your share capital and of course your reserves and surplus, and don't forget the money received against share warrants. Now, in this example, if I have the debt as 5 lakhs and I have equity as 15 lakhs, then the ratio comes out to be 0.33:1. Now, we move on to the proprietary ratio or the equity ratio, which indicates the proportion of total assets financed by shareholders fund, whether it is equity share capital or your preference share capital, and therefore, it is also a good indicator of the solvency of a business unit. This ratio therefore establishes the relationship between a shareholder's funds to total assets of the firm, and therefore, the shareholders funds is the sum of equity share capital, preference share capital, reserves, surplus and minus accumulated losses if there are any of the business unit, and the total resources will be equal to the total resources assets of the firm. A ratio below 50% is risk-free in case of equity ratio for the creditors, since they may have to lose heavily in the event of company's liquidation on account of heavy losses. A ratio of equity which says that more than or below 50% or 50% is a danger mark. Dangerous is a warning signal for the creditors, because in case the company is thinking of winding up, the company's liquidation is near, then they may have to suffer heavy losses. But if the company has more than 75, then the creditors need not worry, and therefore it is safety, it is supposed to be a safety margin for creditors to keep on lending to such a firm or business unit. In the last part of this session, we are also going to do and study about the interest coverage ratio, which is also a very important solvency ratio for us to study. Interest coverage ratio's formula says it is net profit before interest and tax divided by interest on long term debts, and if you see, the denominator clearly defines that long term debts interest is very important for the firm, and therefore, we want to find out if the profits before interest and tax are sufficient to pay the interest on the long term debts or not, and therefore, it is an indicator of the number of times the interest on long term funds can be covered by the profits earned by a firm. A high ratio is always considered better and is always providing a higher safety margin for the long term debtors. Now, let us look at this illustration. Here the net profit after tax is given as 60,000. We have taken a debt, a long term debt, a 15%, it carries an interest rate of 15%. It has to be paid back the principal in 20 installments. The tax rate currently of our firm is 40%. I repeat, we have net profit after tax 60,000, a debt which is long term for us, which we have taken at an interest rate of 15%. We need to pay back the principal in 20 installments. The tax rate is 40%. Now, before we put the values of the numerator and denominator, we need to calculate net profit before tax, which will be equal to net profit after tax into 100 divided by 100 minus tax rate taken together. That means we get a figure of 1 lakh. Interest on long term debt, we need to calculate 15% of the debt taken, which comes out to be 1,50,000, and therefore, net profit before interest and tax would come out to 2,50,000, that is net profit before tax plus interest, which equals to 2,50,000. So, now we are ready to calculate our interest coverage ratios, which is equal to therefore 2,50,000 divided by 1,50,000. Okay, learners, today we have learned all about ratios, and we have learned in part 1 of this session the liquidity ratios, namely our quick ratio and the current ratio. The quick ratio is also better known as the acid test ratio. We also learned the process to compute them or to calculate them. Thereafter, we went on to solvency ratios and learned 3 types of solvency ratios: the proprietary ratio, better known as equity ratio, the debt equity ratio, and also finally we moved on and learned the interest coverage ratios. Now, learners, we are prepared to learn some more ratios in part 2 of the ratio analysis soon at NIOS Studios, and we would be learning together the profitability ratios, the valuation ratios, the leverage ratios together in session 2 of the ratio analysis. Thank you, learners.
NIOS के जरिए नेशनल इंस्टीट्यूट ऑफ ओपन स्कूलिंग या राष्ट्रीय मुक्त विद्यालयी शिक्षा संस्थान, इस संस्थान का एक बड़ा उद्देश्य है आम आदमियों के जीवन को बेहतर बनाना। ऐसे लोग जिनके लिए शिक्षा एक दूर का सपना है या वे बच्चे जो परिवार की रोजी रोटी कमाने के लिए बीच में ही स्कूल छोड़ने पर मजबूर हो जाते हैं। NIOS ऐसे बच्चों और बड़ों को दोबारा शिक्षा से जुड़ने का मौका मुहैया कराता है ताकि वे एक बेहतर जीवन जी सकें। 1989 में स्थापना के बाद NIOS ने देश के लाखों बच्चों और वयस्कों को बेहतर शिक्षा से जोड़ा है। इनमें हर उम्र, हर पृष्ठभूमि, हर जाति, हर मजहब और हर क्षेत्र के लड़के लड़कियां, महिलाएं और पुरुष शामिल हैं। बढ़ई से लेकर पायलट, डॉक्टर, इंजीनियर, बेकर और दर्जी तक NIOS कोशिश कर रहा है सबको शिक्षित और सशक्त बनाने की, चाहे वो असम के दूर दराज इलाके में रहने वाला हो या फिर मुंबई जैसे महानगर का। NIOS ने अपनी मौजूदगी हर जगह दर्ज कराई है। NIOS ने शिक्षा की परंपरागत सोच को ही बदल दिया है। वो पढ़िए जो हम पढ़ाते हैं की जगह NIOS की नई सोच है, हम वो पढ़ाते हैं जो आप पढ़ना चाहते हैं। इस नई सोच ने लोगों को आगे बढ़ने और NIOS के साथ जुड़ने के लिए प्रोत्साहित किया है। शिक्षा उपलब्ध कराने के मामले में NIOS किसी सीमा को नहीं मानता, उम्र की सीमा को भी नहीं। चंडीगढ़ के गणेश के लिए भी NIOS एक वरदान साबित हुआ। NIOS शारीरिक रूप से अक्षम बच्चों को भी बेहतर शिक्षा मुहैया कराने के लिए पूरी तरह प्रतिबद्ध है। ऐसे बच्चों के लिए शिक्षा न केवल रोजगार के द्वार खोलती है, बल्कि उन्हें आत्मविश्वास और गर्व के साथ जीना भी सिखाती है। NIOS खेल के इन सितारों को उनकी सुविधा और समय के अनुसार बेहतर शिक्षा उपलब्ध कराता है। मेरी कॉम, सोमदेव देववर्मन, देविका रेबेका पल्लिकल, अरमान इब्राहिम, प्रद्युमन प्रकाश और अमय जोत सिंह। NIOS सीमा पर खड़े उन प्रहरियों को भी शिक्षा से लाभान्वित करता है जो देश की सुरक्षा के लिए अपनी जान की बाजी लगाने से भी नहीं चूकते। सच तो ये है कि NIOS की पहुंच हर ओर रहती है, चाहे वो दूर दराज के आदिवासी हो या जेल की कोठरी में बंद कैदी या फिर ग्रामीण और शहरी क्षेत्रों के गरीब निवासी। देश में कहीं भी कोई भी व्यक्ति, स्त्री, पुरुष, लड़का, लड़की, अमीर, गरीब शिक्षा से वंचित न रहे। राष्ट्रीय मुक्त विद्यालयी शिक्षा संस्थान का यही मिशन है।
राष्ट्रीय मुक्त विद्यालयी शिक्षा संस्थान पूरे देश में शिक्षा के साथ साथ कौशल विकास के क्षेत्र में बहुत सारे कोर्सेज दे रहा है। लगभग 100 से ज़्यादा कोर्सेज हैं। हम दूर दराज के गांव में अपने संस्थान बनाते हैं और वहाँ के बच्चों को, वहाँ के बच्चियों को, वहाँ के वयस्कों को हुनर के क्षेत्र में शिक्षा पहुँचाते हैं। आपको जानकर खुशी होगी कि अब हम आर्ट, साइंस, कॉमर्स जिन क्षेत्रों में 12वीं का सर्टिफिकेट दिया जाता रहा है, अब हम हुनर के क्षेत्र में, वोकेशनल एरिया में भी 10वीं और 12वीं का सर्टिफिकेशन करेंगे। तो वो बच्चे जो कृषि से जुड़े हुए हैं, कारपेंट्री से जुड़े हुए हैं या दूसरे क्षेत्रों से जुड़े हुए हैं, वो अपने ही क्षेत्र में काम करेंगे, सीखेंगे, हुनर पैदा करेंगे अपने में और सर्टिफाइड भी होंगे कि वो सर्टिफाइड कृषक हैं, खेतिहर हैं। तो आज तक जो हमारे देश में ये सोच रही है कि आप 12वीं पास तभी कहे जाएंगे जब भूगोल, अर्थशास्त्र, भौतिकी ये पढ़ेंगे, अब ये समय बदल गया है। ITI में जितने बच्चे पढ़ते हैं, लगभग 18 लाख बच्चे हर साल दाखिला लेते हैं। अब हम उनको सर्टिफिकेशन करेंगे।
NIOS अपने छात्रों को माध्यमिक स्तर पर 26 और उच्च माध्यमिक स्तर पर 19 विषयों का विकल्प देता है। पढ़ाई किस माध्यम से करनी है, इसमें भी आपको लचीलापन मिलेगा। माध्यमिक स्तर पर ही 7 भाषाओं के अलग अलग माध्यमों का विकल्प मौजूद है। शैक्षणिक कार्यक्रमों के अलावा 86 वोकेशनल शिक्षा कार्यक्रम भी उपलब्ध हैं, जो छात्रों को कामकाजी दुनिया के लिए तैयार करते हैं। वोकेशनल प्रशिक्षण को अधिक सुदृढ़ बनाने के लिए NIOS ने ITDC, सिस्को, इंडियन मेडिकल एसोसिएशन जैसे कई सरकारी और गैर सरकारी संस्थानों के साथ भागीदारी स्थापित की है। आज लाखों छात्रों के लिए अपनी पसंद का स्कूल है राष्ट्रीय मुक्त विद्यालयी शिक्षा संस्थान यानी नेशनल इंस्टीट्यूट ऑफ ओपन स्कूलिंग। NIOS ने एक लंबा सफर तय किया है, लेकिन मंजिल अभी दूर है। निरंतर विकास और नवीनीकरण के लिए NIOS सदैव प्रतिबद्ध है। शिक्षा का उद्देश्य महज रोजगार जुटाना ही नहीं है, बल्कि स्वयं को सशक्त बनाना भी है। NIOS लाखों छात्रों के लिए यही आत्मसम्मान दिलाने में जुटा है। लाखों लोगों के लिए एक आशा और उम्मीद है। नेशनल इंस्टीट्यूट ऑफ ओपन स्कूलिंग। शिक्षा सबके लिए, कहीं भी, कभी भी।
जीवन ये प्रकाशित करने, राहों को आलोकित करने, हम अपना दीपक स्वयं बने, हम अपना रास्ता स्वयं चुने।
सीमा से विद्यालय जो मुक्त हो, धन साधन समय की सीमा से विद्यालय जो मुक्त हो।
कभी पढ़े हम कहीं पढ़े, वे विषय